Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're examining the latest data from Statistics Canada, which indicates that Canadian inflation slowed down in November. However, despite the deceleration, many individuals might not have felt the relief. The Consumer Price Index, or CPI, decelerated slightly, with the annual growth rate dropping to 1.9% from 2.0% in October. This drop was largely attributed to a base effect related to gasoline prices. Interestingly, if we exclude gasoline from the measure, the CPI actually climbs back to 2.0%. Now, while most attention is typically on the headline inflation rate, the Bank of Canada prefers to use the core CPI measures, which aim to filter out short-term volatility. According to these core measures, both the median and trim rates remained unchanged at 2.7% and 2.6%, respectively. This stability suggests that the central bank might interpret the data differently from the general public, who might focus more heavily on the headline figures. Diving deeper into the major components of inflation, Statistics Canada reported a broad-based slowdown among the 8 major categories. However, only 4 of these categories, transportation, recreation, education and reading, household operation, furnishings and equipment, and clothing and footwear, were below the target rate, partly due to steeper Black Friday discounts compared to last year. The other 4 categories, food, health, alcohol, and shelter, remained significantly above the target, and these typically account for a larger share of household spending. Yet, due to a recent methodology change, their influence on CPI has been somewhat reduced. Focusing on the shelter component, we see a mixed picture. While mortgage interest growth has slowed, rents have begun to accelerate again. In November, annual growth for mortgage interest costs was at 13.2%, down from the previous month, which contributed to downward pressure on the shelter component. On the other hand, rents saw a growth of 7.7%, an increase of 0.4 percentage points from October. This dynamic underscores the complex relationship between mortgage rates and rental prices, with cheaper mortgages potentially fueling higher rents as investors take advantage of lower rates. It's important to note that mortgage interest costs have been a significant driver of inflation in Canada, unlike in many other countries where they aren't included in CPI calculations. This inclusion creates a circular effect. Interest rates influence CPI, and in turn, CPI can affect interest rates. This can lead to a skew in inflation figures, making it crucial for consumers and investors alike to look beyond the headline numbers to understand the true economic conditions. Let's delve into the topic of Canada's upcoming mortgage renewal wave, which was once seen as a looming crisis. Observers now suggest that the situation may not be as dire as initially feared. Originally, it was anticipated that the wave of mortgages set to renew in 2025 and 2026 would face significantly higher rates than those available when the loans were first taken out. However, recent developments have changed the landscape. The Bank of Canada's series of interest rate cuts, along with a decrease in fixed rates, have alleviated concerns about a market meltdown due to these renewals. In May, the Office of the Superintendent of Financial Institutions flagged mortgage lending as a top risk to Canada's financial system, primarily because of the impending renewals at elevated rates. This warning came just before the Bank of Canada began reducing its benchmark rate, which has now dropped by 175 basis points, leading to a significant decline in variable mortgage rates since May. Doug Porter, chief economist at the Bank of Montreal, pointed out that the potential for a market shock from mortgage renewals was somewhat overstated. He mentioned that the Bank of Canada was expected to cut rates to avert what was being called a mortgage cliff. Porter noted that the bank's proactive rate reductions were aimed at mitigating this risk, as they were aware of the potential economic impact in 2025 and 2026. The Bank of Canada recently made another significant rate cut of 50 basis points, marking its second consecutive oversized reduction in response to rising unemployment and signs of economic weakening. This move aligns with the bank's strategy to manage the potential risks associated with the mortgage renewal wave. On the ground, brokers are reporting that clients are not experiencing severe payment shocks at renewal time. Matthew O'Neill from Connolly Capital shared that borrowers who purchased homes at lower rates in previous years are not seeing drastic increases in payments when renewing. For instance, those who locked in at around 3% in 2019 or 2020 are now renewing at rates in the low to mid-4s, with payments remaining relatively stable after 5 years of principal reduction. Looking ahead, both fixed and variable rates are expected to continue their downward trend. The Bank of Canada has indicated that while the size of future rate cuts may be smaller, the overall policy will remain accommodative. Tiff Macklem, the bank's governor, has suggested a more gradual approach to monetary policy in 2025 if current economic trends continue. In summary, while borrowers renewing in the next couple of years may face higher rates than before, the increases are not expected to be as steep as once feared. O'Neill concluded that the renewal shock is likely to be less severe due to the recent rate cuts. Even if rates rise from 1.5% to 3.5%, the impact is manageable compared to a jump to 6%. This shift in the rate environment has eased concerns about the mortgage renewal wave, offering some relief to homeowners across Canada. The Office of the Superintendent of Financial Institutions, often abbreviated as OSFI, has announced that it will maintain the domestic stability buffer at 3.5%. This decision, effective since November 1, 2023, reflects the institution's confidence in the resilience of Canada's largest banks, despite ongoing economic and financial risks. The domestic stability buffer, introduced in June 2018, requires the Big Six banks in Canada to hold extra capital as a precaution against potential economic downturns. This buffer works alongside the Common Equity Tier 1 ratio, or CET1, which is a measure of a bank's core capital versus its risk-weighted assets. While the CET1 minimum is set at 4.5%, when combined with the domestic stability buffer and other capital requirements, the effective CET1 requirement reaches 11.5%. It's noteworthy that Canada's largest banks consistently report CET1 ratios above 12%, with some even exceeding 14%. This indicates a strong capital position, which is reassuring in the face of financial uncertainties. Superintendent Peter Routledge highlighted that these stable yet elevated systemic vulnerabilities and low near-term risks to bank capital justify keeping the buffer unchanged. Routledge pointed out that recent stress tests and scenario analyses support the decision to maintain the current buffer level. However, he acknowledged several important vulnerabilities that OSFI is closely monitoring. Household indebtedness remains a concern, with the debt service ratio near record highs. As we look forward, there is an expectation of increased pressure on households as mortgages are set to renew at higher interest rates in 2025 and 2026. Despite these potential challenges, Routledge noted that the situation is less concerning than it was in June, thanks to declining interest rates and the resilience Canadian homeowners have shown through the current credit cycle. However, he warned of uncertainties surrounding real estate valuations, suggesting that a sharp correction in property prices could elevate credit risks in real estate-backed lending. Moreover, Routledge mentioned rising non-financial corporate debt relative to gross domestic product, alongside increasing geopolitical tensions and global policy uncertainties. While these factors haven't directly impacted Canada's financial system significantly so far, they remain areas of concern that OSFI will continue to watch closely. Today, we're taking a closer look at the rising trend of home equity line of credit, or HELOC, usage among Canadian homeowners. According to the latest data from Statistics Canada, HELOC usage has climbed to its highest level in nearly 2 years. As of September, outstanding HELOC balances reached $170.8 billion, marking a 3% increase from last year. This steady rise follows a period of declines throughout 2022 and early 2023. Despite their significance in household borrowing, HELOCs account for just 7.8% of Canada's $2.2 trillion in residential mortgage debt as of September. Although balances remain below their 2012 peak of over $199 billion, the recent uptick in HELOC usage suggests a renewed demand for this type of credit. Several factors may be contributing to this trend. Higher mortgage renewal costs could be prompting some homeowners to turn to HELOCs for short-term financial flexibility. Others may be using HELOCs to consolidate higher interest debt or fund home renovations, which can help them avoid the stricter rules and additional costs associated with mortgage refinancing. Data from Mortgage Professionals Canada indicates that the average amount borrowed from a HELOC at the end of 2023 was $37,495. This figure represents a decrease of $4,165 from 2022, suggesting that while more homeowners are using HELOCs, the average borrowing amount has slightly declined. The increase in HELOC usage highlights a shift in how Canadians are managing their finances amid changing economic conditions. It also raises questions about the potential risks and benefits of relying on HELOCs in the current financial landscape. As always, it's crucial for homeowners to weigh the advantages of accessing home equity against the potential implications for their long-term financial health. Let's turn our attention to a recent speech by Tiff Macklem, Governor of the Bank of Canada, which sheds light on the bank's strategic priorities amidst a backdrop of rising global economic uncertainties. In his address to the Greater Vancouver Board of Trade, Macklem highlighted that the future is looking more uncertain and prone to shocks than we would all like. He emphasized the importance of preparation, noting that the Bank of Canada is actively working to bolster its economic defenses. Macklem identified several transformative forces reshaping the economic landscape: deglobalization, demographic shifts, digitalization, and decarbonization. These forces are significantly impacting jobs, economic growth, and inflation. Compounding these challenges are rising trade protectionism and economic fragmentation, which add layers of complexity to the global economic outlook. As part of its strategy for 2025, the Bank of Canada is focusing on strengthening partnerships with international counterparts. This collaborative approach aims to enhance the bank's ability to respond to economic shocks. Additionally, the bank is improving its economic analysis tools to better address these challenges, ensuring its monetary policy framework remains robust and effective. Macklem also addressed the global economy's vulnerabilities, citing higher sovereign debt, elevated long-term interest rates, and slower economic growth as key concerns. He pointed to geopolitical tensions, war, and the growing threat of protectionism as factors exacerbating these vulnerabilities. Macklem underscored the importance of the G7 democracies working together to tackle shared economic security issues. In a recent policy move, the Bank of Canada cut its key policy rate by 50 basis points to 3.25% in an effort to temper economic growth. While this decision has lowered rates, Macklem indicated that any further rate cuts would proceed at a more measured pace. He noted that inflation has reached the bank's target of 2%, and household spending is beginning to recover. However, Macklem maintained a cautious outlook, reinforcing that while monetary policy has been effective in restoring low inflation, the journey is far from over. With these insights, it's clear that the Bank of Canada is navigating a complex economic environment with a focus on resilience and collaboration. As we move into 2025, these strategic priorities will play a crucial role in shaping Canada's economic response to global challenges. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.